Welcome to episode 2 of Mind Over Market. Today, we are going to explore the extremely interesting and multifaceted case of the GameStop stock squeeze, which was yet another rendition of David versus Goliath, with the big funds and high finance battling against the not so measly retail investors. Though this is not just another banal retelling of the story. Instead, today, we are going to dissect this interesting phenomenon through the lens of behavioral economics, uncovering the true psychological forces that drove ordinary investors to challenge the giants. First, let's set the stage. It's the month of January in the also beautiful year of 2021, and the world is still wrestling with the pandemic. Millions upon millions of people are stuck at home, with so many of them stuck with stimulus checks and loans burning holes in their pockets and time on their hands. Enter GameStop, codename GAME, a brick and mortar video game retailer that many thought was on its last legs. On the 4th of the month, GameStop share price opened at $17.25, and in just 24 days, by the 28th, it had skyrocketed to an intraday high of a whopping $483. Think about it. That's a mind-boggling 2,700% increase in less than a month. But could there have been any fundamental change in the company which sparked this astronomical rise? More importantly, though, what exactly kept it going? To answer a lot of these questions, we need to delve into the nascent world of behavioral economics. Our first stop, the concept of social proof and herd behavior. Social proof is a term coined by psychologist Robert Cialdini. He suggests that in ambiguous situations, we look to others to guide our behavior. Related to this concept is a concept you might have heard before, herd behavior. This occurs when individuals mimic the actions of a larger group, often leading to collective decision making that amplifies small trends. In the case of GameStop, this played out on the notorious Reddit forum r/WallStreetBets. This forum has been described as almost everything in the book, from participants being called wild and unruly to the forum being called the epicenter for cult-like trading behavior, or it even being coined this hive of speculation and risk-taking. As of January 2021, r/WallStreetBets had over 2 million subscribers, and by the end of this month, this number had ballooned to 8.5 million. This rapid growth created a perfect petri dish for social proof to flourish, with retail investors on the forum constantly posting about buying GME and sharing their gains, in turn creating a sort of bandwagon effect. People saw others making money and felt compelled to join in, believing in the crowd's wisdom and feeling the effects of a classic case of FOMO, the fear of missing out. This collective behavior was one of the major reasons for why the demand for the GameStop share price and stock rose to unprecedented levels, pushing the price higher and higher and higher as more and more retail investors piled in. Though social proof and herd behavior alone don't explain for the extent of the ferocity of the GameStop phenomenon. For that, we need to introduce and understand another key behavioral concept, loss aversion. Loss aversion, first demonstrated by acclaimed Nobel laureates Daniel Kahneman and Amos Tversky, showed that people feel the pain of losing more acutely than the pleasure of gaining. In fact, studies suggest that losses are psychologically about twice as powerful as gains. But you must be thinking, how did this apply to GameStop? Enter the short stance. For those of you who don't know, short selling is a trading strategy or mechanism where an investor borrows shares of stocks and sells them, hoping that the stock price will drop. If the price falls, the investor buys back the shares at a lower price and then returns them to the person who lended them and pockets the difference between them. For example, if an investor sells borrowed shares at $100 or 10,000 rupees each and buys them back at $60 or 6,000 rupees, they make a profit of 4,000 rupees or $40 per share. However, if the stock price rises instead, the potential losses are unlimited, as their stock can go. It is the opposite of going long, which is the norm in investing, and is often seen as highly risky. Prior to the squeeze, GameStop was one of the most heavily shorted stocks on the stock market. As of the first of the month of 2021, the short interest in GameStop meaning the percentage of float shares that was sold short was a whopping 141%. Yes, you heard that right. More shares were shorted than actually existed. When the entire Wall Street Bets community realized this, they saw an opportunity. By buying loads and loads of GameStop shares and holding them, driving the price up, all of the institutional investors who had shorted the stock, betting that it would fall, had to buy back shares at a higher price to cover their positions. This is known as a short squeeze. As explained before, they did this in order to limit their losses. And as the potential losses are theoretically unlimited when shorting shares, we know that the losses hurt more than the gains feel good. This asymmetry in the dynamic set the stage for a high-stakes financial battle. As GameStop's price began to rise, short sellers faced mounting paper losses, meaning unrealized capital loss, with a negative figure amounting to $1.6 billion on just the 22nd of January. With this not stopping, estimates suggest that they had lost over $20 billion by the end of the month. Yes, billion with a B. But here's where it gets really interesting. Instead of cutting their losses, many short sellers doubled down, believing that the price had to come back to earth eventually. This is a classic example of another behavioral concept, the sunk cost fallacy. This is the tendency to continue an endeavor once an investment has been made, even when it's not rational or optimal to do so. This is because you're so heavily invested, not just monetarily, but with your time, effort, and emotional energy into something, that one continues on even when giving up is clearly a better idea. This is completely opposite to a rational and optimal way of thinking. As in this case in the past, should be treated differently and completely separately from the present. In economic terms, the losses that institutional investors faced had already been incurred and were far from being recovered. Therefore, this should not be a factor in their current decision making, where they would decided to irrationally double down. If they were to act rationally, only future costs and benefits would have been factored into this situation. While the entirety of high finance decided to go all in, retail investors were not just buying for potential profits anymore. In fact, for many it then became a moral crusade against Wall Street. This transformation brings us to our next behavioral concept, identity economics. Developed by acclaimed Nobel laureate George Akerlof and Rachel Cranton, it proposes that people make economic decisions based not only on financial incentives, but also on their identity. Akerlof also posited that people avoid actions that conflict with their concept of self. And for so many retail investors, holding GME shares became part of their identity. They weren't just traders anymore. They were revolutionaries taking on Wall Street giants. This identity-driven behavior helps sustain the squeeze even as prices reach dizzying heights. But no discussion of the GameStop saga would be complete without mentioning the role of narrative economics, a concept popularized by another extremely famous Nobel laureate and professor at Yale, Robert Shiller. Narrative economics suggests that popular stories that spread through word of mouth and media can drive economic events. The GameStop story had all the elements of a compelling narrative. First, underdogs taking on powerful institutions. Second, the democratization of finance. And third, and most importantly, the promise of getting rich quick. All of this had become an amalgamation of virality, with a compelling underdog story becoming a fire that just could not be put out. It spread across all forms of media. Google Trends data shows that the search interest for GameStop stock increased by over 10,000% in the last week of January compared to the previous month. But sadly, as everyone knows all too well, all bubbles eventually burst. And on January 28th, several brokerages, including the very popular app Robinhood, restricted buying of GameStop shares. This controversial move effectively popped the massive bubble, in turn making the stock plummet. By February 4th, GameStop stock had fallen to $53.5, a nearly 89% drop from its peak. Countless retail investors were left holding the bag, their dreams of riches evaporating almost overnight. Now, As we look back at the saga with the benefit of hindsight, it's crucial to take a look at some of the broader economic and regulatory factors that set the stage for this event. First up, let's talk about the elephant in the room: low interest rates. In the years leading up to the GameStop event, we saw historically low interest rates, a trend that intensified with the economic response to the COVID-19 pandemic. Indeed, the Federal Reserve's target federal funds rate was set to a range of 0% to 25 basis points in March 2020 and remained there throughout the GameStop frenzy. This easy money policy had three main effects. It encouraged risk-taking as investors searched for yield in a low-interest environment. Second, it made borrowing cheaper, including for purposes of leveraged investing. Three, it contributed to high valuations across different and a variety of asset classes, creating a backdrop where extreme price movements became more and more common. The GameStop surge, while extreme, wasn't occurring in isolation. It was part of a broader pattern of speculative fervor that included everything from cryptocurrencies to SPACs or SPACs. Now let's turn to the thorny issues of market efficiency and potential market manipulation. The efficient market hypothesis, coined by Eugene Farmer, suggests that asset prices reflect all available information. But the GameStop episode raised serious questions about this theory. On one hand, you could argue that the market was efficiently pricing in the possibility of a short squeeze. On the other hand, the extreme volatility and seeming disconnect from GameStop's fundamental business prospects and value suggest the market driven more by sentiment and technical factors than by rational and optimal evaluation of the company's future cash flows. And while the SEC's investigation didn't find evidence of widespread market manipulation, the incident highlighted how coordinated action by retail investors could lead to outcomes that blur the line between legitimate trading strategies and market manipulation. This brings us to our third point: regulation of trading infrastructure. The GameStop squeeze exposed vulnerabilities in the US market structure, particularly around settlement processes and the business models of commission-free trading platforms. Remember when Robinhood and other brokers completely restricted trading in GameStop shares? This wasn't just an arbitrary decision. It was driven by the strain put on the settlement system by the extreme volatility and trading volume. The incident has sparked debates about shortening the settlement cycle, increasing capital requirements for brokers, and regulating payment for order flow, the practice that allows brokers to offer commission-free trade rates. Finally, let's focus on a concept that definitely doesn't get enough attention: pro-cyclicality. This refers to the tendency of financial behaviors to amplify economic or market trends. In the case of GameStop, Cordell GME, we saw pro-cyclicality in action. As the stock price rose, it attracted more buyers. Now, this pro-cyclicality can lead to extreme outcomes and can pose challenges for risk management and financial stability. It's a keen reminder that in complex, interconnected financial markets, the actions of participants can sometimes even amplify trends beyond what fundamental factors would suggest. Though aside from this, what can we as retail investors learn about this extraordinary event? It's a stark reminder of how powerful behavioral biases can be in driving market moves. Social proof, loss aversion, identity economics, and compelling narratives combined to create a perfect storm that shook Wall Street to its core. Second, it highlights the increasing power of retail investors in the age of social media and commission-free trading. The GameStop saga demonstrated that when coordinated, individual investors can have a significant impact on the market. Finally, it underscores the importance of understanding not just the fundamentals of the stock, but the psychology that drives its price movements. In the era of meme stocks and Reddit-driven rallies, behavioral economics has never been more relevant to investing. Now, as we end today's comprehensive and detailed episode, I hope that you've gained a deeper understanding of the psychological forces at play during the GameStop short squeeze. Remember, whether you're a seasoned investor or just starting out, Understanding these behavioral concepts can help you make you more informed and rational decisions in the market. This has been Mind Over Markets, and I'm Yuvan Gupta, reminding you to always consider psychology behind the numbers. Until next time, keep calm and invest on. Thank you.